Good afternoon, everyone. We're going to get started in a couple of minutes. So get your water or food well, it is lunchtime, so make sure you have your lunch or your beverage, and we'll get started in a couple of minutes. Esteemed panelists, are you ready?
Let's do it.
Okay.
Ready.
Good afternoon, everyone. Welcome to our Lunch and Learn session entitled COVID Impact on the Insurance Marketplace 2021. For those of you that don't know me, my name is Eric Sauer. I'm Senior Vice President of Government Affairs for the California Trucking Association. It is my absolute pleasure to introduce today's presenter, Jamie Reid. Even though he's a Padres fan and I'm a Giants fan, I will introduce him as best as I can. Jamie is the leader of the complex comp division at C3 and is the chairman of the board. He serves mature business clients that need sophisticated financial strategies to prevent unexpected loss. His background in risk engineering, underwriting, claims management, and actuary service provides unique insight he leverages to advocate on behalf of his clients. Collateral negotiation and swift resolution of difficult claims are areas of his service expertise. Prior to entering the insurance industry, Jamie was the corporate safety director for an international engineering and construction company that built power plants, refineries, airports, and many other projects. Jamie constructed the site programs, staffed the projects, and managed the financial aspects of the controlled insurance programs. He also has a BS in occupational safety and health and an MS in fire science from the University of Central Missouri. I think they won the national championship this year, actually. Jamie is an involved father of three, enjoys his on-field title of coach when not servicing clients or spending time with his wife. Before I turn it over to Mr. Reid, please note there will be a Q&A after the presentation, so submit your questions via the Q&A button on your Zoom toolbar or click the hand raise button to be recognized and unmuted to ask your question. Thank you again for attending today's Lunch and Learn session, and now I'll turn it over to Jamie.
What a very nice and formal introduction, Eric. I think the only thing more agonizing than hearing somebody read your own bio is the thought of talking about insurance for 60 minutes straight. So I'm going to promise to keep the high-level overview to somewhere between 30 to 40 minutes, and hopefully we can make it more about Q&A and what's going on specifically in your own companies. I always like to just start when I'm in front of an unknown audience at the CTA to connect Trucking Proud to the CTA. And in case you don't know, Trucking Proud is an entity owned by the CTA that offers services to its members like DMV, licensing, drug testing, and Trucking Proud Insurance is offering the insurance aspect to you members and transportation companies in California. And so I was hired, commissioned, if you will, by the CTA to stand this thing up and get it pointed in the direction to becoming a valuable service to its members. So that's why I'm here today. And I also like to kind of set a mindset about how to think about insurance as a trucking company owner. You guys are basically a stock. You know, if we go into the mindset of an underwriter who's evaluating how to price your exposure for any particular policy, you're a stock to that underwriter. And if we think about it in the context of the stock market, we have an inverse relationship to the stock market. So in general, when the stock market's doing really well, it creates a surplus or capacity of money. And that money finds its way into the insurance market, where insurance companies can take on liabilities to offset that capital. So when the stock market's doing really well, it increases the supply of insurance, and that drives down costs. I'm speaking generally, right? Not specific to policies or losses. Conversely, when the stock market constricts or there becomes uncertainty, economic issues that cause doubt, those things tend to constrict the marketplace. Capacity leaves the insurance market, and anytime uncertainty is a part of an underwriting process, things get more expensive. So we're kind of in that stage, generally speaking. You know, the market's doing great, but there's a lot of uncertainty around a variety of topics, and COVID being one of the biggest. Obviously, politics and laws play a role as well. But the fact that there's uncertainty fuels this supply and demand issue that we have going. From your mindset, what we try to do with underwriters is get them to want to buy your stock at the lowest price possible, right? Just like when you're buying a stock, you want to evaluate and try to make that investment at a place where it can grow for you. Underwriters are doing the opposite. You want them to spend the least amount of money on your premium, while they want to get the most amount of premium. And unlike the stock market, it's defined 1 year. And so we try to think through it of that perspective, and what do we need to be able to provide underwriters to get them on board with moving their price point from the highest point where they're starting at to a place that's palatable to you. So in general, that's kind of an overview of where the marketplace is. And what I'm going to do is dive into several specific policies. Some of these are going to directly have impact based on COVID, and some of them I'm going to just give you a general overview on. Cyber insurance is probably the hottest topic and issue in our industry right now. I haven't seen statistics on it, but my gut just says it's probably the least purchased policy. It's a little bit of the wild, wild west still, sort of like employment practice liability might have been 10 or 15 years ago. Cyber insurance is relatively new in the space. And the most common thing we see happening right now, I titled it foreign hostile takeover. It's literally like kidnapping your IT system. And it's happening to where I can tell you at least 2 of my specific clients have had it happen. Both of them were between 100 and 500 employees, just to give you some perspective. But it has happened to companies as small as 10 employees. So nobody's immune. And what happens is you, as the owner or leader in the company, get a call probably at 5 a.m. from an employee who's trying to do something, and your system's just gone. Your email is gone, your accounts receivable are gone, routing and management ability of your fleet is gone. You can't access anything. And a communication comes through where somebody indicates to you, we've taken control of all of your IT infrastructure. And it's very easy to get it back. You pay us $1 million or $2 million, meet us in this dark corner of the dark web, and exchange a Bitcoin type currency with us. And we're going to give you a key and you take your systems back. So imagine if one of your truck drivers were in somebody right now and it's not too bad, you could probably figure yourself through that. You don't need an insurance company. But when a group out of Russia or Africa or China takes over your entire technology infrastructure, you don't have, most of you do not have, and including us, have a starting point of how do we recover this and get back to whole. So I have 2 clients recently, like I said, one of them had purchased this, the one with about 300 employees. We immediately turned the claim in to the insurance company. They assign a cyber specialty negotiation group with us. They say, hey, we're familiar with this particular group that's making this demand. We're going to interact with them. They do. They started at a $2 million demand, talked it down to a $250,000, I guess, negotiation, if you will. And they exchange that currency on the dark web. They get the key back. They take control of their entire infrastructure in 48 hours. And then the insurance company further work with them to put preventive measures in place to keep that from happening again. Our other client didn't purchase this insurance. The demand was $1 million. They didn't want to pay it. So they hired an IT company who told them they could get their systems back. It took over 3 months to just get basic infrastructure, one email at a time, literally clawing it all back together. The company's trying to come out of financial ruin now. And so the two are in very different places. The key about cyber insurance, it's really cheap right now. I mean, if you buy employment practice liability, you're going to have these large deductibles, and it may or may not make sense for you. Cyber insurance is cheap, so everybody should be getting it. It frequently will be included in the directors and officers package, or it can be an option that you purchase within it. So if you do buy D&O, that's a good time to evaluate it if you haven't added the cyber component to it yet. So D&O is directors and officers coverage. It's what we like to call a catch-all type policy, right? There's a variety of things it can apply to, but there's a fiduciary liability policy that fits within this umbrella, and probably the most commonly purchased is employment practice liability. And employment practice liability, as you probably know, it's in a hard market. Directors and officers coverage is in a hard market in general as well. And then from the perspective of COVID has added all kinds of complexity to the employment practice liability. We're under a mandate by Governor Newsom that work comp claims are covered unless you can essentially defend your position and prove that they weren't contracted at work and get them excluded. And so your engagement, when somebody notifies you that they have COVID, has all kinds of things that need to activate. One small part of that is if it's not work related and they're having a difficult time with COVID, how do you interact with those people to guarantee their job and go through what in California is called the interactive process? And so the EPL policies that are renewing in 2021, the underwriters are still carrying uncertainty about how COVID is going to play in this and what businesses are doing to interact with employees who notify them they have COVID. So Chris McNatt is on here, and Amy Saldivar. I'm going to introduce both of them at the end when we open up Q&A. But either one of them may be well served if you have specific questions in that arena. All right, so maybe the least applicable to most people here, unless you have significant warehousing operations or you have significant property, but I think it's worth commenting and just so you understand, commercial property is in a very hard market. It's natural catastrophic events that are occurring out there. What used to happen 10, 20 years ago was that insurance companies would underwrite commercial property vertically in the country. So maybe they write the West Coast, Oregon, Washington, down to California, and California had a really bad fire season. It could be offset by what's happening in the North. Well, in modern times, if you will, we're experiencing a major fire events in California every year. It's not every other year, every 3 years like it used to be. The frequency of these catastrophic events are happening at an alarming rate. And then you couple that with other areas of the country that you would hope would offset that bad experience. And they're seeing increased hurricanes, and they're seeing increased significant rain and hail and snow events that are damaging roofs. And so there's just kind of nowhere to hide on the commercial property front if you're an insurance company. These events are everywhere that we populate en masse. And so if you do have significant property that is covered on your insurance policies, just a couple things. I mean, this is mostly going to be driven by market conditions that are out of your control. However, you know, property updates are going to be scrutinized much more. You know, I remember 15 years ago, we just make them up on the app. Oh yeah, it's a 40-year-old building. They did all updates 10 years ago. And underwriters would never ask anything about it. But I didn't do that. Some people did that. Now anything on aged buildings is being scrutinized by underwriters. So truly having, you know, adequate updates can impact this policy. And maybe more importantly, we're finding it's easiest to work with your current insurer on property. If they're non-renewing and we have to go somewhere else, the likelihood of that policy cost going up significantly is exponential. So if your insurers come out, done a loss control, written you recommendations, interacting with those recommendations to remediate them as quickly as possible professionally, underwriters have a good taste, their loss control has a good taste. It's probably your best way to try to keep everything under control on the property front. All right, so the area that impacts everybody the most, commercial auto in general, whether we're talking about trucking or not, it continues to be a hard market. That said, we've started to see some carriers, insurers, I'll say, in the trucking space increase their appetite recently. And that's a sign that over the past 5 years, a lot of them took rate increases and they're starting to get back to a place where they're not losing as much money. So commercial auto is one of those. If your rates did inflate significantly over the past 5 years and your losses are in check or good, you could be at a stable place. If on the inverse of that, if you somehow were able to manage without significant rate increases over that period of time, and or you have loss activity, you have bad cab reports, safer, all of the underwriters are going and they're reading those reports in fine detail. So if you're not green on your cab scores, or you have things that are obvious signs of mismanagement, like wrong licenses, wrong endorsements, things like that, it's going to be scrutinized heavily. So commercial auto is definitely in a hard, but it could be a place that's okay. The complication that has happened in that space is, take 2020, for example, we had commercially 15% less miles driven on the road last year. Makes sense. The economy halted for a while, right? So our trucks and our commercial vehicles drove less, but we still had an increase in fatalities. And the thought process is linking the smart device that's sitting in all our hands, right? We have these little computers that are constantly engaging us at every front on social media and telling us where to turn, et cetera. And so we're continuing to see catastrophic losses and fatalities in the space. And these losses are getting out of control. So much they're getting out of control that they've been phrased as nuclear verdicts. So nuclear verdicts are exactly what they sound. It's where we're unable to come to an agreement prior to trial with those that are bringing suit against us, and we go to trial. And in trial, an unimaginable amount of money is given to the plaintiffs. And if you think about the first one I remember was like the McDonald's hot coffee, right? Where the hot coffee spilled on the lady, and I think they awarded $4 million or something for burns to her hand. It's that same kind of reaction. And where an accident that kills somebody differs from an accident that kills somebody, but the employer, the trucking carrier, you, is put into a position where a nuclear verdict happens, is because the population at large is putting the burden on trucking companies to prevent these scenarios. And they're saying it's not simply enough to do a little bit. We need you actively engaged in having company policy, training, et cetera, to try to prevent these things. And where that doesn't exist, and or where repeat accidents have occurred in the past that have indicated something catastrophic could occur, and it goes to jury trial, we're seeing these massive verdicts that are $100 million plus, 500, $700 million. And it's easy to understand how you could get to a jury trial. We're seeing demands come in death cases that exceed 10 and $20 million right out of the gate. That often exceeds the limit of insurance, even under excess for the average trucking company. So you're in a rock on a hard spot right out of the gate in a lot of these demands. And it's a risk if you don't have really good controls that are in place to prevent getting into a jury trial. And I would argue if you have really good controls in place, then your ability to take that initial demand and work it down is probably heightened significantly. So let's talk about that a little bit. What does it look like? And there's a few things. A few of them are easy, and a couple of them, require a little bit more investment on your part. So the easy thing is a cell phone policy, right? Anyone can contact us. We'll give you one. I'm sure your broker, insurer could give you a copy, or you just get on Google and type trucking company cell phone policy. These things don't need to be complex. They're much like your basic OSHA plan that says who's going to be in control of it, what the company policy is, how you're going to train and educate your team, and how you're going to hold everybody accountable. That's a policy, right? Everybody can and should definitely have that in place. Beyond that, you need documented training. We need a way to communicate with the employees what is happening out there that is causing these nuclear verdicts, so they really understand it. And again, most of the good insurance companies out there have resources. We have one we provide to clients, and my dad is a 65-year-old truck driver with ABF. He still emails me from his AOL account. So it doesn't have to be a company email account. It can be their personal. We can set it in the system. This 20-minute training is actually really, really good. You heard in that horrible bio that Eric read on me, safety is my background. Most safety videos I don't really like, but the one that we have available, it takes somebody who was hit by a commercial vehicle and survived but has brain damage, and the parents died, and they talk you through it. So it's a really good video, and it's just not cheesy like others. So very easy. It's free. It takes 20 minutes. You should do it on paid company time. All your drivers go through that, right? So those first couple things, super easy, right? The third thing is that image down on the bottom right. Any cell phone device will do that can take that little computer out of their hands. I've personally tested several different pieces of hardware. That particular one, John, I think is going to put a link to it in the chat window. It's from a manufacturer called Tough Tested, and it's called the Mammoth Mount. And it's called the Mammoth Mount because it's like it sounds. It's big, it's heavy, it's got a suction cup, the size of my head right here that can adhere to the window or the dashboard of the truck, and you get that device out of their hands. I can imagine some trucking company owners might be skeptical that these things are going to walk away, and that might be a real risk. They're $30 each. I don't think they're on Amazon. I think you have to buy them direct. It's just like any other PPP you provide to your employees. If you have to give them hard hats or reflective vests or hard-toed shoes, all those kinds of things, I would definitely be providing that hardware, because I wouldn't want to have to take the stand and be questioned by an opposing counsel that says, that's great, you had a policy, you did a little bit of training, you never gave them the tools they need to actually effectively do this. Why didn't you spend $30? And then you're like, you're back into a rock and a hard spot, right? So those things are really good. And again, I have a Sprinter van that's pretty heavy and big, and it holds up great. A footnote here is some of you provide company cell phones. And even in that case, just know almost always your employee is also going to have a personal phone. So it's going to apply both to their personal and their commercial phones. If it is a company issued phone, you do have the ability to add a little bit more protection, and that there are a series of apps out there that can disengage texting. So it'll hold the incoming text message until the vehicle stopped. and it can automate a response to the other party indicating that they're driving. And so there's too many options, and depending on what cell phone type you have. But if you have more questions, it's an easy Google search away, or we're happy to help you later. If you want to reach out to us, we'll put up all our company information. And then last thing, which is taking it to the next level. And this is where I see the future of this happening in every truck around America. It's not there yet, but it's going to come as these nuclear verdicts become commonplace. In-cab cameras. And I do know that there's a sensitivity to privacy and, to the big eye in the sky, or the uncle always watching the drivers. But that technology is not going to go away. It's going to become more prevalent. There's two in particular that we like that John's probably already put in the message window, but Netrodyne's one of them. That camera, the driver eye is seen there. There's another one, Samsara, that's very closely behind it. They're both good companies, good technology. What we like about those cam systems is they have a next level technology that can read what the driver's doing and anticipate if there's at-risk behavior. So without somebody having to human monitor their behavior in the truck, those systems are going to send it. And then you're going to be pulling your driver in and say, hey, the driver eye saw that you were on your cell phone, 10 times during the drive over an hour period. Per our company policy, this is your warning. You need to retrain. You get one more warning, 3 strikes and you're out. And I see that world becoming more prevalent. It might not sound like that's where we're at yet to a lot of you, but if you get involved in enough of these really bad claims, the writing's on the wall. So just something for you to be aware of, and it's definitely going to impact policy costs at some point on the auto front. I feel like I've been talking a lot. All right, almost there. And then we'll get to Q&A. So umbrella and excess might be the hardest market. Umbrella and excess going up astronomical. I mean, we have clients that are paying $1 or $2 million and their policies have doubled from one year to the next. It's a crazy marketplace. And that's indicative of capacity being drawn out of the market, like I talked about in the beginning, coupled with these nuclear verdicts where we're seeing a new normal. It used to be that 1 million as primary coverage was sufficient. Now we're seeing the carriers that are taking on primary liability having to put up $2 to $5 million because those excess carriers are seeing more and more claims penetrate that primary layer. And that's really not the intent of excess. So the excess market is responding, it's constricting, it's raising rates because the supply is going away. So things we can do there, cost control is everything. The number one thing on any claim front, whether it's auto, work comp, COVID, where we see people miss the boat the most is the initial indication. How are we investigating this situation, all hands on deck right out of the gate? And so having a full team that activates around that claim from a cost control perspective is absolutely paramount. Taking it to another level, if we're controlling the defense counsel that represents us with the insurance company, that helps a lot. A lot of the adjusters are in lockstep with the underwriters. So there's no filter there on what's going on with the claim. The underwriter can know that information fairly easy, even when it's a TPA. Defense counsel is the one putting the strategy together to resolve these claims. So anytime we're coming up on renewals, claims that are more than 50% of primary limits, we have to be working with defense counsels to write a narrative on how are we going to resolve this claim at the lowest amount possible. And we're trying to guide the defense counsel that if there's hope that it can be resolved within primary, that we need them to tell that narrative. And so we have specific use cases where we've successfully mitigated increases because of intimate involvement by our defense counsel on those claims where we haven't yet reached settlement, but we're sitting on big reserves. And then the last thing, and really the reason I suggested we bring Chris McNatt on, although he may need to get involved on some of the COVID questions too, but is around contingent liability. And on contingent liability, I have at least 2 clients where sub-haulers' claims against others have hit their excess policies now, and it's called contingent liability. And it's a significant issue. So way back before ABC and AB5, Borrello, all the problems around employment classification, independent contractors began, everybody had sub-haulers on their primary transportation company. That sub-haul exposure is where contingent liability comes into play. And so what we're seeing through work with Chris and Scopolitas or other law firms, and I'm just speaking, when we walk into an organization, we have to understand how their different entities are structured. What we're seeing more and more is that we're splitting, or you all are splitting asset companies away and keeping the asset company as a transportation company and taking the non-asset company, the sub-haul exposure, and moving it into a brokerage company. So that's obviously being done to protect the assets, right? And if we do get into a wrongful classification suit, or we get into a excess contingent liability situation, then that's being contained within that brokerage and not coming over and exposing the assets of the transportation company. So we see those brokerages being created at the direction of counsel around these topics. We see financials being separated, where the transportation company has a set, the brokerage has a set. We see sub-haulers moving over to the brokerage and being relabeled as independent contractors who carry their own MTC, their own insurance, their own titles. We see all that work being done. And then more than 50% of the time, when we get into the insurance, we don't see the insurance moving like that. We see sub-haulers on the primary policy of the transportation company. And so a lot of intellectual work and I assume money is going into this process of separating entities for specific reasons. And a lot of the time we're seeing the insurance not match that. And so part of it is we want to shield the contingent liability, get the brokerage its own complete set of contingent liability, from cargo, general liability, auto, work comp. It has its own suite of coverage that sits over the top of those motor carriers. And then the transportation company has its own direct insurance for its exposures. We are frequently seeing that the legal work and the insurance work are not in alignment. And I think I have a theory, which I don't have a use case for, but I could imagine some case that Chris is defending in the future at some point where these policies are subpoenaed. And it could be an employment classification issue where they're trying to assert, for whatever reason, that they're employees under the brokerage, whether it's AB5 or some other mechanism triggers this activity. And when they subpoena the transportation company's information, the brokerage is listed as a named insured on it. And there's a sub-haul exposure there. And that doesn't tell the same story that we see happening legally. So for those of you that are going through the effort on the legal side, the word of caution or advice I would give is make sure insurance is engaged and that you're insuring things the same way as you're structuring them legally. All right, so I'm coming up on my 30 minutes here. Last thing's work comp, and COVID-19 is going to have an impact on work comp. As you know, work comp is statutory, meaning there's no coverage amount. You know, somebody who's paralyzed could get $10 or $15 million in benefit or medical care. So work comp was what I would say stable, but at the bottom rate. We're at historically all-time low work comp rates coming into 2020. In 2019, none of the insurance companies built in rate for illnesses like COVID-19 or the flu or anything else. It wasn't costed in. Well, now it's covered until we prove it's not a workplace exposure. which takes some work, right? So COVID-19 claims are hitting, death claims are being paid. The long-term effects of vital organs to those that are most at risk are still unknown. It's a tale that could last, for 30 or 40 years potentially. So it's going to add cost to the system. How much, we don't know. I don't think it's a catastrophic reaction at this point. But I will tell you, I just recently had 2 clients with the same PEO get letters, and the PEO said you have 30 days notice, we're doubling your rates. And we're like, what is going on here? They're like, look, we're not selling an annual policy like the traditional market. Changes in our rates require 30-day notice. They've reported a bunch of COVID claims. We don't think they're controlling it right. We're raising rates. So that's the first kind of alarming behavior that we're starting to see. And I expect to slowly see more claims have tail and impact on cost, but probably not catastrophic in nature in some acute sense. A couple things to know. If you haven't seen it, we put out 3 blog posts. The most recent is around audits, work comp audits from policies that originated in 2019, where you're impacted by COVID. So some of you may have been non-operational for a while or significantly impacted. You may have taken PPP funds and continued payment to your workforce, even though they weren't working. There is a mechanism to assert that at your audit and claim back premiums already paid. So Amy wrote that article. She's on and going to be available for question and answer here in a minute. But that's one impact. Another is that if there was a change in operation, people were moved from warehousing to something lesser to just keep them employed during a period of time. They became more clerical in nature or began working from home. There are class codes that were created for that are clerical in nature from a rate perspective. And there are certain things that you'll need to do to prove, give them information that that's the case and try to recover that premium. So that's on the audits. And then from best way to mitigate COVID exposure is obviously to eliminate it. You're not going to be able to have truck drivers just work from home, but you could move, your finance department can work from home. Anyone that's involved with scheduling, routing, anything that's office type work can be moved from home. And I have friends that own insurance agencies who still have everyone showing up to an office and saying, hey, we're essential workers. Well, that's true by definition, but they don't essentially need to report to an office and they can be working from home. So all that's doing is allowing an exposure to exist that isn't well defined. We don't know what it's going to look like. So anywhere you can, I would just eliminate that exposure altogether while the rest of this plays out. And then the last couple things to talk about here is 1159 and 685 each have reporting requirements, which can be confusing, can be burdensome on businesses who are otherwise trying to run businesses and not in the occupation of managing COVID. So that's a moving target. We have pieces written on each of those, and I think John's going to put each of those blog articles in the chat room. But it's a good segue to introducing Amy and Chris. Amy Saldivar is Director of Claims Advocacy at C3 and Trucking Proud. And she's in a different stratosphere when it comes to work comp claims. She is knee deep in COVID claims, COVID deaths. She literally has hundreds of them with our clients. It's a space that's not going to go away anytime soon. And she's wonderful. So her contact information, she's on the top left here. And then Joe Fisco, who's on the bottom right, he's the one who's helping us from a safety and loss control keep up with the reporting requirements, which OSHA has involvement with. And so he's a great resource on that front as well. And of course, you can contact me anytime you like. And then I'll also, as John, I think, is going to come back on here and facilitate our question and answer. Chris McNatt, like I said, is he knows transportation and trucking better than any attorney I've ever met. Scopolitas specializes in the industry nationwide. They're fantastic. Anytime you have a labor law issue, he's the guy I personally go to because he knows the industry so well. And we're happy to move into Q&A from there, John.
Okay, thanks so much, Jamie. So once again, folks, we're opening up Q&A, so please feel free to either submit your questions via the Q&A box on your Zoom toolbar, or you can click on the hand raise button to raise your hand. I will see you, allow you to start speaking. You'll unmute yourself and you can ask the question out loud. And I don't see any questions coming through just yet.
John, let me step in for a second.
Yes, sir.
If any questions are not going to be coming in, I just wanted to touch base on a couple of things that Jamie raised. Stepping back into the excess insurance exposure issue and the nuclear verdict issue. As most of you know, the ATA has been working with trucking associations, state trucking associations, on combating these nuclear verdicts. So stay on top of that. They're taking a very aggressive approach on pursuing the fraudulent claims that have led to some of the nuclear verdicts. But one other thing to keep in mind that Jamie touched on is the role of defense counsel in working with large claim exposures. The other type of counsel that you may want to consider in a catastrophic accident is negotiation counsel, who's not directly working to present a defense to your case, but to interface with the family's attorney, and your insurance carrier to see if it's appropriate to have an early resolution of a catastrophic claim. It's an excellent way to minimize your company's exposure and to reach a resolution of catastrophic claims that need to be addressed head on. And then touching on Jamie's subject with regard to contingent liabilities, is absolutely correct. If you do establish a brokerage operation, you do want to assure that you treat that company as its own standalone company. And if it's its own standalone company, it has to have appropriate coverages as a broker, contingent liability coverages, addressing negligent selection, and issues such as that with regard to the underlying carriers that are being retained by your brokerage operation. Those are just a couple thoughts on the excess and the contingent liability issues that Jamie talked about.
Good points, Chris.
Okay, so I still don't have any questions or raised hands. So folks, please don't be shy. Please feel free to submit any questions you might have into the Q&A box, or raise your hand to be recognized and ask your question out loud to the group.
It could just be confirming my assumption that 30 minutes is capacity for people to consume insurance in the trucking space. And we don't fault them for that.
Okay, still nothing coming through, folks. Okay, so we do have a question here from Joe Giamona. In the case of a workplace death of an employee where a death benefit is paid through work comp, is there still liability exposure?
Amy, do you want to come in on that, or you want me to take it?
There could be liability exposure from a serious and willful on the workers' comp claims, depending if they were essential and they were put out in the workforce to work. Then I could see an S&W coming too. I haven't seen one yet, but I do foresee them in the future. What about you, Jamie?
I think you're right. But would you also maybe just give a quick explanation of serious and willful for those who...
Yeah. So serious and willful is basically a good example would be you have a hole in the wall at your workplace, you know it's there, or hole in the floor, excuse me, you know it's there. You don't put signs around it. I walk in and I break my leg. You've essentially not protected me safety wise, and you put me in harm's way, where I can file a serious and willful, which is a civil lawsuit outside of the workers' comp policy. And it's not, sometimes it can be covered under your insurance policy, under the EPLI sometimes, but they're not always guaranteed. Is that right, Jamie?
Yeah, it's a punitive damage, so it depends on how the bill is structured.
Mm-hmm. Yep.
All right, folks. So I don't have any other questions just yet. I see that Peter Schneider is attempting to submit a quick question. But I do have another question that came through the chat box, actually. What can carriers do right now to help reduce future rates and insurance liability?
Well, that's generic, right? We have to go through each of those policy specific things, but the number one thing that we see outside of prevention, right? There's all the prevention things that we talked about. Where we see money bleeding away is sitting in claims. And the number one thing that we don't see happening is true claims advocacy. So an event happens, so the truck gets totaled somewhere. It could take 5 or 6 days in a normal situation for the insurance broker to find out, and then a day or two loss for the insurance company to find out, and then an adjuster, it just trickles down, right? So what we advocate for is the broker becoming a part of that insurance investigation in the moment it happens, that it's all brought through recorded lines and it activates a team of people. So I think by and large, we do a pretty good job because it's a heavily regulated industry, right? You're not just hiring chumps without proper licenses. We're having to abide by all that already. So assuming that's in place, then I think all hands on deck and having that system set up for effective communication right out of the gate is big. And then your insurer recognizing that it's real. Because a lot of companies, advocate that they do those things, but it's not actually viewed by the insurer.
Okay, thank you, Jamie. So we have Peter Schneider with a question. Jamie, you secured excess for me last spring. From spring to now, how has it changed? It was double to triple last spring. Is it still the same?
Yeah, I think if you went through that double to triple pop, you've probably bared the brunt of the market adjustment. So I don't want to give away too many aspects of your program, Peter, but there were some things that I spoke about in aligning the organization and the legal strategy with the insurance strategy that weren't aligned in your situation. So part of it was the market responding to that. And part of it is just the market in general. So I think you've gone through the general market response in that excess taking a hit. And then we've worked with you over the past year to realign the insurance to the way your organization's structured. So I don't foresee massive rate increases per se. And then you and I'll jump offline to, talk about the strategy to try to bring that heavy increase back down.
So I do have a follow-up question from Peter for you, Jamie. And he explains, with us splitting off into separate companies last year for contingent liability, et cetera, you saved us money. Is that normal with splitting, or does it depend on each company?
Yeah, it's I haven't seen a situation where we move the sub-haulers off of the asset company and onto the brokerage from an insurance perspective, have it not save money. Because the insurance companies are rating that sub-haul exposure on the primary transportation almost as if it's your trucks. Like it's gotten that expensive. And so when it's really a brokerage entity that's just a shell and doesn't have assets, and they're real companies with their own motor carrier permit, their own insurance, their own titles, that contingent liability is typically a lesser cost. I've never not seen it be less.
Okay, thank you, Jamie. So we have an additional question coming in from Tom Powell. With the new OSHA regulations focusing on how employers are mitigating the possibility of preventing COVID claims, how active is OSHA going to be?
Oh, that's a good question, Tom. Your guess is probably as good as mine. Joe Fisco is not on this call. He'd be the guy to field that. I don't know. I think it's all written out in theory. I certainly wouldn't go scaring my clients that OSHA is imminently showing up, but we are advising them to make the notifications. One, it can be as much as $5,000 fines right out of the gate if you're not notifying OSHA appropriately. And they have a surprising amount of checks and balances, hospitals required to report and things of that nature that I don't see a huge risk to just reporting it. And so if I were in any one of your shoes out there, I would be playing ball on the reporting requirements, because we live in a state that can carry a big stick on hitting businesses. And I just don't see the risk to not reporting it. But in some light, that's all TBD. I think it's a good question.
And just to follow up on Jamie's comments, and to plug Friday morning's panel, Linda Alderdice from Holland and Knight will actually be touching on the OSHA COVID issues in the scope of our presentation on Friday morning. So tune in for that. And then keep in mind that even though field examinations may be not as frequent, when you're dealing with notifications and things such as that don't require field investigation, it's not hard to continue moving forward with an aggressive enforcement perspective.
That's why you're here, Chris.
Okay.
Taking the hard questions.
So
There we
I
go.
don't have any more questions coming in just yet. Or raised hands. Once again, folks, we do have a few minutes left here, so please take advantage of this panel. Please feel free to submit any of your questions either through the chat box, through the Q&A box, or by clicking the raise your hand button, in which case I'll unmute you to be able to ask your question out loud to the group. Okay. Well, I don't see any more movement here. Jamie, Chris, Amy, anything else you'd like to cover? Before we go ahead and close out, I'll kick it back to Eric once we're ready.
No, thanks so much. Over to you, Eric.
All right. Before we close this out, we're going to give you one last shot to ask that burning question. Okay. Not seeing any. I want to thank our panelists for this very informative session. And I want to thank you, our members, for attending today's session. We are going to have an hour break. So we'll reconvene at 2 o'clock for our next session, which is entitled To the Limit, Port Congestion and Solutions. That will begin at 2 o'clock. So once again, thank you everybody for attending today's Lunch and Learn session. And we look forward to seeing you at 2 o'clock. Thanks again.
Thank you.
Thanks.